Trusting a standard hotel pro forma? Yeah, that's literally the fastest way to lose millions of dollars in commercial real estate. See, brokers and sellers, they're incentivized to paint this beautiful picture of frictionless growth. But if you take their numbers at face value, man, you are walking blindfolded right into a financial buzzsaw. In this explainer, we're tearing down those perfectly packaged projections and exposing the raw, unvarnished reality of hotel acquisitions.
Here's the massive value you're going to get today. Learning and applying the 5-part stress test we're about to cover is absolutely the only way to bulletproof your next acquisition. We're comparing that 12-month pro forma illusion, you know, that magical spreadsheet where revenues just naturally scale up and to the right, against the brutal 48-month reality of actually operating a hospitality asset. If your underwriting model can survive the gauntlet we're laying out today, well, then you've got a deal worth pursuing.
Chapter 1, the NOI Ramp-Up Trap. We're leaving behind that illusion of a frictionless path to revenue and entering the actual operational timeline.
Okay, let's dive into this. You actually face a brutal 36 to 48-month stabilization curve. First off, expect a 15 to 25% occupancy penalty during your renovation phases. I mean, think about it. Dust and noise absolutely kill bookings, right? Second, once you reopen, it takes another 12 to 18 months just to build guest trust and drive true average daily rate, or ADR, growth. Because of this massive lag, you absolutely have to inject a dedicated 3 to 6 month working capital buffer. If you don't, you risk defaulting before your hotel even finds its footing.
Chapter 2, Unmasking True Brand Fees. Let's shift our focus from where your revenue is delayed to where it's secretly leaking out.
Sellers love to purposefully isolate that tiny, innocent-looking 4 to 5% basic franchise fee. But when you actually stress test the underwriting, you find all these hidden layers. You've got loyalty program fees hitting 4 to 6%, central reservation system and tech surcharges at 1 to 2%, plus those mandatory marketing funds. So your true all-in operational leakage, it's actually a massive 9 to 12% of your gross room revenue.
And hey, the leakage doesn't stop with the franchise tag. You've also got to factor in a 2 to 3% base management fee based on total revenue. But here's the real kicker. You need to structure subordinated incentive fees that are tied directly to gross operating profit or net operating income thresholds. If the property underperforms, management needs to feel the squeeze right alongside you. You absolutely have to ensure total financial alignment for the downside, because let's be real, the pro forma is never going to show you one.
Now that we've exposed the true cost of brand fees, we have to look at the biggest threat to your margins. Chapter 3, the expense inflation reality.
Applying a uniform 3% inflation index across all your line items is a dangerous, dangerous myth. Let's break this down a bit. Market-specific labor scarcity means you've got to model wage inflation at up to double the baseline consumer price index. Utilities, they consistently index way higher. And please, reject that weak 2% allowance for property improvement plans. You have to enforce a strict 4 to 5% furniture, fixtures, and equipment reserve simply because physical plants degrade incredibly fast.
Now, what's really interesting about this is if you're operating in coastal, freeze-prone, or storm-exposed markets, you need to underwrite a massive 15 to 30% annual escalation in property insurance. Seriously. Commercial insurance markets are hardening fast, and relying on a standard 3% bump, that's going to let a single renewal cycle completely wipe out your cash flow. No way around it.
Chapter 4, Exit Caps and Liquidity Risks. We're moving from operating expenses to your terminal disposition risks and capital market volatility.
When you're analyzing an exit strategy, you have to absolutely shatter this naive assumption that capital markets are going to be perfectly stable when it's finally time to sell. Pro formas almost always model terminal cap rates at, only 25 to 50 basis points wider than the entry cap rate. It's such a convenient little assumption that magically forces the internal rate of return to look incredibly attractive.
Let's look at how this builds under a true stress test. You really need to apply an exit cap rate spread of 100 to 150 basis points above your entry. Plus, you absolutely must model your disposition or refinancing with debt costs 150 to 200 basis points higher than today's rates. And at that higher cost, your asset still has to support a debt service coverage ratio, or DSCR, of at least 1.35x. If the math breaks there, well, your asset is illiquid.
Chapter 5, Stress Testing Market Demand. We're pivoting from macro debt costs to the actual guests walking through your front door.
You constantly hear sellers brag about their historical market penetration index, or MPI.
But listen, past performance dominating a static competitive set, that is a terrible shield against localized demand shocks. Historical MPI simply does not guarantee future survival, and banking on it is a huge critical underwriting flaw.
Instead, you've got to execute a localized sensitivity analysis. First things first, map out every single planned room within a 3 to 5 mile radius, because as new supply comes online, your competitors are going to aggressively discount their rates, which drags down the entire market's occupancy. Second, really analyze your demand generators. Are you heavily reliant on just one corporate headquarters or maybe a local university? You have to mathematically model a brutal 20% decline in that specific generator just to see if your cash flow can actually withstand the hit. So, look closely at your underwriting. If your market's single demand generator vanished tomorrow, would your assets survive the shock? If those pro forma numbers are literally the only thing holding the deal together, you don't have an acquisition, you have a liability. The absolute bottom line here is that this 5-part stress test is what separates a resilient wealth-generating asset from a catastrophic capital trap. Model the friction, expose the true fees, disaggregate your inflation, widen your exit assumptions, and stress test your demand.